Hey everybody, Ricard Torres here, dividend investor and entrepreneur. In this video, I'm going to reveal the 3 top mistakes that I see dividend investors make all the time. Now, these mistakes are pretty bad, guys. These can actually derail your progress. They can actually mean that you don't get the returns that you deserve as an investor. And this is especially important if you are a beginner investor, because if you make some of these mistakes, you might get burned, you might actually quit investing altogether. And that's pretty much the worst thing you could do. I've actually made some of these mistakes myself, and it was actually learning from those mistakes that allowed me to now have a portfolio of dividend growth stocks that routinely pay me over $700 every month on average, okay? And that actually covers a lot of my living expenses, okay? It's pretty cool. So listen up, because you need to know what these 3 mistakes are and how to avoid them. And actually, guys, if you stay till the very end of this video, I'm going to reveal the 1 stock that's in the market right now that I've been personally buying, and I actually believe is one of the best opportunities to make money out there in the market right now, okay? So that will be at the end. Before that, let's get started with the video. Okay guys, let's get stuck in with those 3 mistakes. Mistake number 1 is not starting earlier. This goes for investing in general, but really the sooner you get started, the better. It's a little bit like that quote that I'm sure you've heard before that says, the best time to plant the tree was 20 years ago. The second best time to plant the tree is today. Well, that same thing goes for investing, guys. The sooner you start, the better. That's because you can actually really get compound interest, which is one of the most powerful mathematical forces in the world, and actually Einstein called it the 8th wonder of the world. The sooner you start, the more time the compound interest works for you, and is exponential, meaning that the first few years are going to be really slow. That's why, the sooner you start, the better, but then it grows exponentially, okay? And actually I've got a quick example to show you, and you might have read similar examples about this, but let's say on one side we've got you, all right? You've got you, and on the other side we've got a friend of yours, perhaps a less handsome, less clever, less charming friend, and you both want to invest. The only difference is that you invest starting right now and your friend waits 10 years. And you know the usual excuses, right? I can't afford to invest. I've got my mortgage, I've got my expensive car, I've got my holidays to pay for, my student loans, right? All those things, all those reasons that prevent people from starting to invest. And obviously tackling your debt is very important. It should happen before you start investing. But when that debt is a mortgage on an overpriced home, or the repayments on a car that you don't really need, or a second car, then those are really things getting in your way and preventing you from actually starting to invest and really getting compound interest. So yeah, you start right now and you invest for 10 years. You invest $1,500 every month. And again, guys, this is just an example. This might be a lot for you. This might seem like a little for you, but you invest $1,500 every month. But here's the kicker, right? After 10 years, you stop investing altogether, right? You never invest again. And that's exactly the time that your friend starts investing. Now, obviously your friend realizes that, he's been missing out on great chances. He's seen your portfolio. It's growing really nicely. So he says, right, I'm actually going to invest double. I'm going to invest $3,000 every month, and not just for 10 years, but for 20 years, okay? So I'm going to invest double for double the time, okay? Now, at the end of that period, at the end of those 20 years, so 30 years for you, right, from when you started investing till, nowadays, you might expect that your friend would have more money than you, but you'd be wrong. Your friend would have $2,300,000, something like that. You would have $2,700,000. So that's significantly more than your friend has by having invested way less money, a much smaller amount of time, but just earlier. So yeah, guys, invest early and get started now. If you haven't got started, guys, I'll create way more of these videos, okay, to help you get started to invest. And if you like what you're seeing, please consider subscribing to my channel so you get notified whenever these videos are coming. Also click like, because this helps my channel to grow. It's the best thing you can do to support this channel. But yeah guys, get started as soon as possible. And by the way guys, if you want a more practical example of the power of compound interest and how to actually apply it, I've actually got a video out that shows you how by saving just $5 every day, you can actually become a millionaire with enough time, okay? So that will be down in the description. Make sure to check it out. I think it's a pretty good video, if I say so myself. But now let's move on to mistake number 2, guys. And that is being attracted by yield traps. Now, if you don't know what a yield trap is, it's basically a stock that has a very high yield. And that yield might be something like 10% or 12% or 15% dividend yield. And if you don't really know much, or you're just really looking to get that passive income quickly, you might be tempted. It's a bit like in the film Finding Nemo, where Dory and Marvin, they're in that really dark bit of the ocean and they see a shimmering light. Okay, and obviously they're attracted to that light. And obviously at the end we realize that it's actually an anglerfish and it tries to eat them. Well, dividend traps, guys, are very similar. They might not eat you, but they will definitely eat at your wealth. That very high dividend yield, that might be really appealing at first. And of course, who doesn't like a very high yield? The problem is it's probably not going to be sustainable. That company will probably pay that really high yield for a year, maybe 2 years, but you can be pretty sure that it will have to cut its dividend. Or maybe eliminate the dividend altogether, because that puts a lot of strain on the actual underlying business. So what I recommend is to stick with dividend growth stocks that grow the dividends every year and have a yield, maybe you can go up to like 5-6% dividend yield, but even that's getting a bit risky, okay? And that's where you have to look out for the payout ratio. Now the payout ratio is basically what percentage of the company's earnings are they distributing to their investors, to you if you're a shareholder, How much of all the money that the company makes are they paying in dividends? If that percentage is very high, and some, higher than 70%, that dividend might be in danger. It's one of the best ways to realize or to see whether the dividend is safe. So always look for that payout ratio, make sure it's kind of lower than 70, preferably lower than 60 or 50, that's a really nice payout ratio. And yeah, just don't be attracted by those high yields. Those yields that they seem too good to be true, and it's because they are, guys. They are too good to be true. Now the third and final mistake that I see people making, dividend investors making, and this actually goes for a lot of people as well, and that is going with the crowd, okay? People succumb to the fear of missing out, also known as FOMO, F-O-M-O. People see that everybody is investing in Bitcoin or everybody's investing in Apple shares. They want to be a part of that. They don't want their friends and their family to get rich and for them to be the only ones that didn't actually invest and also got rich. So that's why they do it. And a great example is Bitcoin. A couple of years ago, everybody was buying Bitcoin. I had so many friends asking me about Bitcoin, what was my opinion on Bitcoin, whether I was investing in Bitcoin, and I didn't invest in Bitcoin. I will actually make another video just on Bitcoin, but what happened, guys? People bought when everybody was super cheery about Bitcoin, the price was going up and up and up and up, and then what happened? The price crashed, and because all those people didn't know anything about Bitcoin, they just sold and they made losses, and then they told everyone that Bitcoin is awful, okay? So that's a great example of people going with the crowd, people not really knowing what they're getting into. So yeah guys, that was mistake number 3. Always do your own due diligence, always do your own research, have your own plan, and don't always get swayed by what other people think or what other people are doing, especially if everybody is doing it, okay? Do your own thinking and you will easily avoid this mistake. So just to recap, guys, the first mistake was not starting earlier, so start now if you haven't started already. The second mistake was to avoid yield traps. So to do that, just make sure that the payout ratio is low, lower than 60%, and that the yield is not higher than 6% or something like that. And the third mistake was not to be swayed by what everybody is doing, not to succumb to the fear of missing out. Dividend growth investing, guys, that's what I talk about on this channel and on my website, escapingthefreedom.com. is a very boring strategy, let's be honest. It takes a very long time for you to actually get significant results. You know, it can be quite a few years. However, once you get past that stage, once you get past those first years, compound interest really starts to kick in, and that's when you get amazing returns. You get great returns on your share price, and also those dividends coming in. That real passive income that you don't have to do any work to earn, that can actually pay your bills. It can pay for you to live, so that one day you never have to work for money again, unless you really want to, okay? Okay guys, as promised, I'm going to now reveal this stock that I've been buying, and I think it's one of the best opportunities in the market right now. This is 3M. It's a manufacturing company. The ticker symbol is MMM, so that's 3 M's in a row, hence the name. And the best part about this company is that it makes just kind of really boring stuff that you probably use on your daily lives, right? It's got Scotch electrical tapes. It makes adhesives, duct tape, right? So this is all its consumer stuff. It also makes stuff for pretty much any industry that you might imagine. Oil and gas, manufacturing, energy, electronics, right? Very, very well diversified company. And also guys, the best bit is that this is a dividend king. That means that it's been increasing its dividends non-stop for over 50 years. And in fact, 3M has been increasing its dividends at the time of recording for 61 years in a row, guys. This is the kind of company that just ticks all the boxes. It's safe, it's boring, it creates stuff, and it sells stuff that people need, that the industry needs, and probably always will need. And going back to step number 2 in this video, it's actually got a payout ratio of around 60%. So you know this is by no means a yield trap. And it never would be with a dividend yield of 3.3%, right? So anyway, this was my little stock pick. Of course, always do your due diligence. This is by no means a recommendation that you should go and buy this stock. I personally did. I personally have bought it several times. I love this company, but always do what's good for you. Always do your own research, okay? So guys, as always, thank you so much for watching. Thank you for taking the time out of your day to watch one of my videos. If you could do me a great favor, please click the like button if you found this video useful. That helps YouTube to realize that this is a good video and it will show it to more people. Also, please consider subscribing. That will really help my channel, and you will get notified when next videos come up. And from now on guys, I plan on releasing a lot of new videos, a lot of really valuable content. So make sure to click subscribe, and make sure that you click on that little bell icon so you actually get notified when new videos get released. And also guys, lastly, please comment, let me know what was your biggest mistake when investing. I would love to hear, I will read all comments. And also if you got any ideas for future videos, you know, I really want your guys' input on my channel, okay? So yeah, please comment, click like, subscribe, you know, the usual YouTube trifecta. And yeah guys, thanks again for watching this video, and I will see you in the next one. Take care.